Welcome to all the viewers here in this regular series, NFO series, where we interact and understand the brains and logic behind this new fund offers that are coming in the market. What are the reasons? Why should you subscribe to all these NFOs? What were the strategies that were put in place? How these NFOs are beneficial for your investment journey? And we interact with the top heads of the AMCs. And today with us, we have Mr. Anupam Tiwari, Head of Equities at Groww MG. Welcome to the talk, sir.
Thank you. Thanks for inviting me here.
Yes, sir, today I think we are discussing the Groww Multicap Fund, One India, Multiple Growth Opportunities. Before we start the discussion, I would like to tell our viewers that the NFO period starts on 26th November 2024 and it ends on 10th of December 2024. So, sir, the very first question that I have is that this fund offers the QGARP, that is quality and growth at reasonable price. So what differentiates this QGARP philosophy from other fund management approaches in the Indian market?
Okay, so how we kind of came out with this philosophy, which is QGRP, is that we tried to address the fundamental questions of investing on first principle basis.
Correct.
Is that why we make investments, right? So the idea behind buying any equity stock or making an equity investment is to compound your wealth.
Correct.
In compounding, you want two things. You want a slightly higher rate, whatever is the possible higher rate of compounding. And you also want a longer duration of compounding.
Correct.
That is why like your wealth grows disproportionately.
Correct.
So then we asked, what are the factors which drive higher compounding and longer compounding?
Correct.
Right. So these are two basic fundamental questions that we asked ourselves. And then we realized that companies which are good in quality,
correct,
quality of earnings is good, who are growing, have a scalable business model, are companies which compound at a higher rate and for a longer duration.
Correct.
Right. And then if business is compounding, but you want your portfolio to also compound, valuation becomes very, very important.
Absolutely.
So basically, valuation is the determining factor of relationship between business ka compounding and your portfolio ka compounding.
Correct. Correct.
Because there might be a situation where, let's say, a business is compounding. Because good businesses will always grow at some rate, right?
Yeah, absolutely.
10, 15, 5. But your portfolio or your investment in that business may not compound just because of valuation.
Correct.
Right. So that is how we came out with these three factors: quality, growth, and valuation, or at a reasonable price. That if you enter at a reasonable price, then you can also ride alongside the compounding of the business at kind of same rate. Right? Otherwise, your compounding would be lower than the business compounding.
Yeah.
If, let's say, valuation mismatch is there. So now what is quality? What we call is quality. So quality ensures life of compounding. And it ensures that one, the company will sustain, it will survive for next 10, 15, 20 years. And secondly, that it will be able to get through bad times very quickly, easily, without too much of damage. Bad cycles will come, right? In every country, every economy, every company, there is always a possibility of some kind of negative cycle happening. In that sense, we need to have companies in our portfolio where our compounding is not interrupted. And that is why quality is very, very important.
Correct.
Now, quality has two aspects. One is the promoter quality and second is the earning quality.
Yeah.
So promoter quality is basically corporate governance. If your governance issues are good, they are solid, then your ability to compound for a longer period of time and your ability to go through bad times becomes much more better.
Yes.
You have a much more strengthened ability to go through a bad time, right?
Correct.
So that is why we look at corporate governance. That's one very important thing for us in terms of quality. And then we look at quality of earnings. Essentially, things we look at is balance sheet. Balance sheet should be optimally in terms of risk of it should be optimally positioned. Will we need to kind of understand the debt profile of the company and
Correct.
how it is generating operating cash flows, etc. And
Correct.
second thing we look at is good ROEs.
Correct.
Right? Because good ROEs are the most important determinant of compounding for any investor.
Correct. Correct.
So that's a two important thing. The third thing we look at is growth. So of course,
Correct.
growth, as the name suggests, the business should be capable of growing, etc. Opportunity size. But
Mm-hmm.
point we look at it is how good or how capable is the management in terms of capturing that growth opportunity.
Correct.
Whether
Correct.
they have been able to do right execution, whether they are taking calibrated risk. Right?
Mm.
We don't want a company management or promoter which is taking too much of risk. We also
Mm-hmm.
don't want somebody who is not taking risk.
Correct.
Right? So you want somebody who is like calibrating his risk so that he can, grow at an optimal rate, who is able to attract good talent, etc., who is kind of trying to gain market share in relevant fields. So these are things we look for growth.
Correct.
The third thing we look for is valuation.
Mm.
Because as I said, the differentiating factor of compounding of business and compounding of portfolio is valuation. Right?
Mm.
We want to have a entry point to be very good
Mm.
so that our portfolio also compounds along with compounding of business. So this
Correct.
is how we kind of try to address and make our decision making much more systematic.
Okay. So the next question then comes is that how does this top-down approach for large caps and the bottom-up approach for mid and small caps improve the portfolio diversification and performance? What is the logic behind that?
Yeah. So if you look at the space, large cap and the mid and small cap space. So in large cap space, generally, the
Hmm.
money is made out of earning upgrade downgrade cycle.
Correct.
Multiple derating and re-rating doesn't happen quite often.
Yes.
And even if it happens, it is kind of associated with earning upgrade downgrade cycle, right?
Okay. Okay.
Whereas in case of mid and small caps,
Hmm.
there is earning growth, one part of the capturing of stock price increase. And there
Correct.
is another part is which is your multiple re-rating or derating, right?
Correct. Correct.
But in case of small caps or mid caps, multiple re-rating, derating is also associated with much more confidence in that company over a period of time.
Hmm.
Whereas in large caps, you already have confidence, right?
Hmm.
So you are only looking at that earning upgrade, downgrade part. So
Hmm.
that is why in mid and small cap, we take a bottom up approach.
Hmm.
And it kinds of hedges our risk in terms of macro, etc. And
Hmm.
we look for individual companies, their capability, etc. And then, of course, there is always a kind of macro thought process, sectoral, etc. But
Correct.
that's not very, very dominating in our mid and small cap decisions.
Hmm.
Whereas in large caps, because things are already discovered, you
Hmm.
pretty much know the multiple re-rating, derating potential, what can happen. So we
Correct.
look only for earning upgrade, downgrade cycle. And
Okay.
for that, we take a top-down call.
Okay.
How to relatively position in terms of sectors, etc., in the portfolio. We first take the sectoral call and then we
Hmm.
take a stock call. So it
Okay.
kind of helps us be more sensitive towards valuation in large caps
Mm-hmm.
and be more agile.
Mm-hmm.
In large caps, we want to remain very active in
Mm-hmm.
terms of our portfolio allocation.
Mm-hmm.
Stock selection plays a role in large caps, but allocation plays an important and I would say much higher role in,
Okay.
right? And mid and small cap selection plays a very, very important role. So that is why we have kind of a very different approach towards large and small and mid cap selection.
Okay. So the next question are about these market dynamics and sector allocation that, as you briefly touched upon these points, is that given the dynamic nature of the Indian markets,
Mhm.
how do you identify the high growth sector for large cap investments?
See, in large caps, one is you have to look at the competitive positioning of the company.
Okay.
Because generally, large cap sectors, there are very few monopolies except the commoditized business.
Yes.
There are very few monopolies. So, one,
Correct.
of course, you can have that, you can invest in those companies. Let's say, for example, aviation, right, is
Hmm.
one example where we have a very skewed monopoly of,
Hmm.
right? But other than that, generally in large cap, you don't have monopolies.
Correct.
Maybe some government regulated businesses or commoditized business.
Hmm.
Let's say, for example, coal, etc.
Hmm.
Traditionally, historically, we have monopolies. So their situation is different, but otherwise, the only growth areas that you can identify is companies which are expanding their opportunity size. We are expanding their customer segment size. And that's why like we are very gung-ho on premiumization, premium consumption. So in
Okay.
B2C companies, one has to look at companies which can dominate market share and are the challenger which are challenging the leader and gaining market share. These are, I think, this is the most important factor that one needs to look at it, is the market share gain to
Okay.
identify which can be the growing companies.
Okay. So then this is kind of a very, what we can say, it's a very regular question that you must be asked on almost on a day-to-day basis. Which sectors do you currently see as having the most significant and potential across large cap, mid cap, and small cap? I think it's fairly very common question.
Yeah.
We get around asked a lot, and now it's a multi-cap fund that you guys are coming up with. I think it makes a lot of punch as well.
Yeah. So I think after recent fall, a lot of sectors have become attractive.
Yes.
Broadly, if you like kind of segregate Indian market, Indian companies, there are three parts, broad three parts. Number one is export oriented. So
Okay.
you have services as well as you have manufacturing, right? So for example, chemical, engineering, etc. And in services, you have IT, etc. Right?
Yes.
So I think that is one area where we think is good opportunities, especially going ahead in future. Manufacturing exports, especially niche and much more customized exports of manufacturing goods can be a very, very good opportunity. And that is where we can gain market share. Services, of course, because we have gone through the pain of Western problem. Now it's bottomed out. So that could be a good area itself.
Yeah.
On the domestic front, you have B2B businesses or commoditized commodities or capex-led businesses.
Correct.
And then you have B2C businesses, right?
Yeah.
Branded, etc. So on the infra side, we are pretty positive. I think that the capex cycle will keep on doing better for next 5-7 years. There could be hiccups, etc. But we are fairly confident that this will continue. So that is the area, and we are positive on it across market cap segments. So be it a small cap, mid cap, or large cap, good companies will continue to do well. The third part is consumption. So consumption you can break in two parts. It is one is staple or regular consumption, and second discretionary or maybe slightly premium consumption. We are not very positive on staple consumption because there is competitive scenario is very, very strong. Even on the discretionary part on the lower segment, not so premium, the mass segment competition is very strong. So there, we think that sustainable good ROEs are not possible. Margins can be at risk. Growth can be.
Yes.
So, yeah. And but premium consumption is still there. There are a lot of good niche stories that are doing very, very well. So there we are very, very positive.
Okay. Sir, then this is actually next. The question is actually next in line about the growth opportunities. Now, how does the fund aims to position itself or to benefit from the emerging themes like maybe let's say export, premium consumption, and financialization, as you said just the previous minutes ago.
Yeah. So see, basically, we are evaluating ideas across the board. Right? So financialization is one emerging theme that is coming in. So India has created a very amazing DPI, right? Digital public infrastructure. And utilizing that, a lot of new businesses model are coming.
Correct.
So those new business models we have to evaluate. Some of them will really become good. And they will become very efficient and they will create value for investors.
Correct.
So we are absolutely open. India is also having a generational shift. Right. So now a new generation is coming up, which was born with mobile and internet. They are now coming into this age profile where they are becoming earners.
Correct.
Right? People who have born between, let's say, around 2000, beginning of the century. Now they are like 24, 25-year-old. Now they are getting into earning cycle. So they may have a very different consumption profile and consumption. Right. So we need to be aware of these facts. And so we are open to all. Financialization is actually giving us a lot of opportunities across because it is helping companies to reach customer better and process and evaluate risk better. So that is also one area where we are looking very actively.
Okay. So actually, the next question does follow your point, that is risk evaluation and concerns risk management. Is that how does the fund assesses and manages risk associated with the high growth small cap stocks?
Okay. See, if you look at sources of risk in any stock, right? Be it a small cap, large cap, or mid cap. So there are broadly two type of risk, right? One is external, the environmental.
Correct.
Or the macro risk.
Correct.
Where we don't have any control.
Correct.
So we need to kind of build in that into our valuation framework or projection framework where we do that should not be too aggressive in terms of our projections, etc. And durability of research, etc. comes into play.
Correct.
Another source of risk is internal source, which is like unique to the company.
Yeah.
And these are four.
Yeah.
Essentially, if when you are buying a stock, you are taking four risks. One is the promoter risk. Second is the business risk. Third is the business cycle risk. And fourth is the valuation risk. So we try to manage our risk at the very beginning level in all these four criteria. So we prefer to not to take promoter risk, not to take business risk. We will not buy a bad promoter. We will not buy a bad business.
Yeah. Yeah.
And business cycle risk and valuation is something that we need to optimize. Never say that we will always get it right. Make mistakes, but that is where sizing comes into play in terms of portfolio. So we manage it through cycle and active agile churning of the portfolio.
Correct. So now the last couple of questions are related to the investors. Is that with a minimum investment of ₹100, how do you view this fund as an entry point for first-time mutual fund investors?
I think this is the best product, multi-cap, because of two things, right? It's that it gives them exposure to all the market cap segment.
Okay.
Be it small cap, mid cap, and large cap in a very balanced way, right? You have minimum exposure of 25%. You have kind of getting a assured exposure, right? And you don't need to churn in between so that there is no taxation impact if you have different kind of scheme.
Correct.
The second thing is that it is a very disciplined approach.
Yeah.
Right? Because you have to ensure minimum allocation. And in market and in investing, discipline is more important than anything else.
Yeah.
Right? So I think these are two very important factors which make this product a very, very suitable and unique product for investors.
Correct. So the last question is that the Nifty 500 multi-cap, 50, 25, 25 index has shown impressive Sharpe ratios and CAGR returns. So with this NFO, how does the fund aim to outperform or match the benchmark consistently?
Yeah, so I think one is our ability to do good research and pick good stocks. That would be one. And second is, I think, an very agile and optimum allocation of the remaining 25% between different market cap categories depending on context would be the key for us to actually outperform the benchmark.
Okay. Thank you so much, sir. Thank you so much for your time. It was great to speak with you. I wish you all the success and all the, luck that the NFO gets oversubscribed and opens to a huge response when it's time. Thank you again to coming here and speaking with us, sir.
Thank you. Thank you very much. Pleasure to be here.
Thank you so much. Yes.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.